For more, we're joined by Stephen Nash from FIIG Security. Stephen, thanks very much for your time this afternoon. Let's go with covered bonds. Announced on Sunday, I should say. A positive, do you think, for the banking sector? It seems, in terms of the banking inquiry we've had at the moment, at least, this idea of trying to generate deeper and other pools of funding for the banks is a positive.
Yeah, I think broadly it is quite a positive for the whole sector. I think starting it off with quite a small percentage is probably a good idea. Covered bonds are very big in Europe, have been very successful for a very long period of time. And I imagine that initially the major banks will use this, and then the smaller institutions will also be involved in this market. I think you can have people full on limits, for example, the major banks, but with a covered bond that may allow the banks to issue into the same investor but with a different limit. So that would potentially give them a lot more issuance power and diversify their funding. I think this is all about diversifying funding, and going forward it's very important that we get that and hopefully reduce reliance on offshore funding.
Why the importance? I mean, how does our corporate and covered bond sort of market at the moment compare with others? I mean, is it not a particularly mature one? Is there not much of a market as it stands?
Well, in Australia we have quite a low allocation to fixed income. I mean, I've got a bit of a bias, I suppose, but we do. I mean, globally, if you look at the OECD figures or you look at other consultants' figures, we tend to have a very high equity allocation, and because we have a fairly low bond allocation, that means the banks have to go offshore because our market is a certain size, and they tend to go to offshore markets. And at the moment, it's quite expensive to hedge those funding deals back into Australian dollars. So I suppose that's the reason we have a low allocation to fixed income. So one potential solution to this situation would be for a government policy to increase allocation to fixed income. I think that broadly, how would you do that? You'd probably look at increasing the tax neutrality between equities and bonds. I think the Treasury's already looked at that, so we're going into that. Maybe some cap on growth assets in super funds would be sensible, but we have to wait and see.
Do you think, in terms of an investor perspective, if we do start to get more of these, these bonds, these covered and corporate bonds into the market, is the demand there, do you think, for them? Because at the end of the day, the government can pump as much money as they want, $4 billion, taking up to $20 billion to deepen the pool there. But if investors don't want it, then it's not really going to help the banks, is it?
Well, I think, there's got to be some measures, some policy measures on the demand side for fixed income. I think the tax situation is one of them that I think really has to be addressed. And I think also in terms of the RMBS market, it is improving slowly, and I think the way that the government has approached it is they've continued to invest in the senior pieces of the RMBS with a view to exiting at some stage when the market fully recovers. Now, the problem with providing a guarantee, I think, for the government is the exit strategy. So I think that's probably a valid way to look at the market, in the sense that the government's assisting now with a view to exiting at some point in the future when the market recovers.
Just quickly, I wanted to ask you, I was listening to the banking inquiry yesterday, Yellow Brick Road Wealth Management. Mark Burris was talking about these loan pools in terms of the securitisation market, getting them almost government-backed or credit rating agency-backed, so that they become less risky and more, I suppose, investor desirable. Yeah. And that way you can start making up a separate exchange to start trading these on, and that can come up as an alternative source of a second form of funding through securitisation. Is that something that we should start to look at as well?
There has been some discussion of Australia adopting the Canadian system of government support. I think that requires a lot of work, and I think over time we could look at that, but I think, as I said before, that the problem for the government in going into these, launching into these guarantees, it has to be very well thought out, so that if they have to exit or there are problems, they have to be thought through very well. For example, I mean, if the government was to guarantee a lot of loans and there were problems with the loans, what effect would that have on government finances? So it's more of a long-term or medium-term project, yeah.
All right, Stephen, look, always a pleasure to talk. Thanks very much for